Hello and welcome to Chapter 1. Introduction. Part of Practical Bookkeeping Theory. Brought to you by the Association of Practical Accounts, APA.
Hi, my name is Kate, together with Paul, to take you through this chapter. We only appear on this slide, but we'll be talking to you through the whole chapter. To get the best from us, we request for silence and maximum attention. However, if there is anything not clear, please replay the slide or video as many times as you want. We wish you all a good learning session.
Chapter Overview. 1.1. The bookkeeping function is on slide 4. 1.2. Importance of accounting information is on slide 18. 1.3. Users of accounting information is on slide 28. 1.4. Some accounting terms is on slide 41.
Section 1.1. The bookkeeping function. Bookkeeping is part of the accounting process. The bookkeeping function involves the 5 tasks illustrated below.
In the bookkeeping function, there is a chart of accounts which should be understood. Next we have the management of documents, which involves filing. We have the recording of information from documents. We have the verification of what is recorded, and the correction of discovered errors. Finally, we prepare periodic reports.
Bookkeeping involves understanding the chart of accounts, knowing how to organize documents, recording from documents, checking for errors and correcting them, plus the preparation of periodic reports.
Here we have an illustration of the detailed activities in the bookkeeping function. There is pre-recording knowledge we should know before we start any recording. We should know how to manage documents, have a proper understanding of the chart of accounts, the VAT implications of different transactions, and know how disallowed expenses are recorded. 1. It involves recording of opening balances and reversing some of them. 2. It involves recording income and other receipts, both the ones paid for and those on credit. 3. It involves recording purchases and other payments, both the ones paid for and those on credit. 4. It involves carrying out some procedures before submitting a VAT return. These include verification and correction, and this may involve the suspense account. Detailed VAT reports are prepared in the process. 5. Post-VAT tasks include recording wages and the different reconciliations, which include bank and loans, preparing trial balances and using the suspense account in case of any exposed errors, carrying out a trial balance comparison in search of unexposed errors, and preparing a cumulative trial balance. 6. Verify creditors and debtors. We have the creditors reconciliation, individual creditors reconciliation, plus debtors reconciliation. 7. Periodic reports that summarize all the records.
The accounting function involves the supervision of the bookkeeping function, carrying out year-end adjustments, and the preparation of final accounts, plus supporting reports as illustrated below.
All businesses are required by law to perform the bookkeeping and accounting functions. Bookkeepers, accounting technicians, and accountants are trained to perform these functions on behalf of businesses.
In this module we provide a detailed explanation for all the stages in the bookkeeping function, plus all the background knowledge like the chart of accounts, source documents and their management, means of payment, plus others. Accounts as a subject is a study of what is involved in the bookkeeping and accounting functions.
Bookkeeping is based on documents, and it's done monthly or quarterly. We should be able to manage documents before recording. We start by identifying documents, classifying them into the 4 major categories, which are income and receipts, purchases and payments, wages, and the banking documents. The documents are then filed before recording the information on them.
The recording process transforms information on documents into transactions. We start with opening balances, then income and non-income receipts, purchases and non-purchases payments, and finally banking and wages documents.
After recording, we have to check and correct any errors before we continue. To check for errors, we use VAT formulas, the trial balance, cash reconciliation, bank reconciliation, loan reconciliation, credit card reconciliation, creditors comparison, debtors comparison, etc.
What is recorded in bookkeeping is summarized into periodic reports, which include the VAT return, cash and bank summaries, the trial balance, profit and loss account, balance sheet, creditors list, and debtor list. The bookkeeping process is done for each of the 4 quarters or 12 months in a financial year.
At the year-end, we embark on the preparation of final accounts, which is started with year-end adjustments. This includes the recording of unsold stock or materials, depreciation, debts written off, accruals, income reserve, prepayments, advance income, plus bank account reversals. We only do what is relevant for a particular business.
After adjustments, we prepare a final trial balance. It's the figures on the final trial balance that we use to prepare the final accounts, which include the profit and loss account, balance sheet, plus their supporting reports.
Hi, we thank you for your cooperation through the past slides. We hope you are gaining some knowledge in the process. Please remember to note down anything important or requires clarification. You may discuss with a colleague, an accountant, or a tutor nearby. Your next option is attending our free online tutorials, where you ask any questions. Your last resort is sending an email to admin@practicalaccounts.com. If you need to have a break, just press the pause button. Otherwise, we keep firing on all cylinders. All we need is your silence and undivided attention. We have more information to share with you. Thank you.
Section 1.2. The importance of accounting information. This refers to the circumstances in which we can use accounting information. The most commonly used are the financial statements, which are also known as the final accounts. They are put to use in many circumstances, but the most common are explained below.
1. Profit measurement. Profit is the excess of income over business expenditure. We get this figure on the profit and loss account. Profit is the most important reason why the owner starts a business. They need to know whether they are making profit or a loss.
2. Ass's performance. We use accounting information to tell if a business is getting better or worse by comparing results for one period with another, or one year against another year. We can also judge its performance by comparing with reports for similar businesses.
3. Wealth measurement. We use accounting records to identify what the business has, and to tell if it's wealthy when compared to others. This information comes from the balance sheet.
4. Taxation. We use accounting records to determine how much tax is paid by a business. The higher the profit, the higher the tax to pay.
5. VAT. This is a value-added tax, which is added to most items sold. In UK it's 20%, and it's added by only VAT-registered sellers to their selling price. We use the sales and purchases records to calculate how much VAT is paid to the Revenue Authority, or how much refund is due.
6. Debtors Management. A debtor is a customer who buys goods or services without paying the whole amount immediately. When you buy on credit, you become a debtor. A debtor owes money to a business. We look at accounting records to know which debtors owe, which debtors don't pay, and which debtors should not get any more credit.
7. Creditors Management. A creditor is a person or business that sells goods or services to a business on credit. Money is owed to a creditor. We look at accounting records to know which creditors are paid, and which ones are not yet paid.
8. Borrowing. The banks and other lending institutions look at accounting records to determine if a business will be able to pay back what they want to borrow. Accounting records are an important guide before the bank decides to lend money.
On this slide is a summary of the importance of accounting. Section 1.3. Users of accounting information. After accounting information is prepared, it's then put to use by various groups of people as illustrated below. The different users of accounting information include the owners, managers, employees, the government, suppliers, the public, lenders, plus customers. Below is a brief explanation about the different users. Owners. These are the people who invest capital and own the business. They are interested in knowing how much profit is made. If it's a large business where managers are different from the owners, the profit size is an indication of how well the managers are managing the business.
Managers. These are people who run a business on a day-to-day basis, on behalf of the owners. Their challenge is ensuring that the owners are happy with their work. How well they perform is often measured by the amount of profit made. They use accounting information to judge their performance, as well as setting future targets.
Lenders. These are people or institutions that lend money to businesses, and the most common are banks. A bank is a financial institution which keeps money for people, businesses, schools and government departments. It also lends money and provides other services like exchanging currencies.
Before they lend out money, they should be satisfied that the business will be able to pay back, including the interest charge. So they look at the past accounting records, plus the projected future performance before lending. They also look at what the business has in form of assets to provide as security.
Government. Their main interest is taking a portion of profits made by businesses in form of taxes. Some governments through the Revenue Authority take 30% of net profit, leaving 70% to the business owners. Some governments also take a percentage of most sales revenue in form of VAT. The government uses tax money to provide public facilities and services like security, roads, schools, hospitals, and others.
Suppliers. These are the ones who sell goods and services to business for either cash or credit. Before they sell to a business on credit, they need to be sure the business will pay. They assess the ability to pay basing on financial records.
Employees. These are people who are employed to work for a business. Their interest is knowing if a business will survive and continue to provide employment as a source of income. However, they rarely have access to accounting records. If they do, then very few understand them.
Customers. These are the buyers of goods and services provided by a business. This may be a person, another business, or an institution like a school. Their interest is knowing if a business will continue providing goods and services at good prices and quality.
Accounting information may not be very important to an individual consumer. It's more important to a large supermarket which buys from manufacturers. If the manufacturer's business doesn't have a future, they need to identify another source in good time.
The public. This is the general community in which the business operates. They are interested in knowing if the business is giving back anything to the community. This is because the profit made by the business comes from their expenditure. Is the business contributing to environmental protection, providing jobs? Is it planning to expand or shut down?
Hi, we thank you for your cooperation through the past slides. We hope you are gaining some knowledge in the process. Please remember to note down anything important or requires clarification. You may discuss with a colleague, an accountant, or a tutor nearby. Your next option is attending our free online tutorials, where you ask any questions. Your last resort is sending an email to admin@practicalaccounts.com. If you need to have a break, just press the pause button. Otherwise, we keep firing on all cylinders. All we need is your silence and undivided attention. We have more information to share with you. Thank you.
Section 1.4. Some accounting terms. A. Businesses and institutions set up to engage in activities aimed at making profit. In order to make profit, the money generated in form of sales should be more than what is spent, known as expenses.
A transaction is any dealing between a seller and buyer that involves the exchange of goods and services, or the payment for them. Examples of transactions are the purchase and sale of goods, the purchase of assets for use in a business, the payment for wages and salaries, rent, and other business expenses.
There is always two parties to a transaction, as one is buying the other one is selling. As one is paying the other one is receiving. When a transaction takes place in a business, it's recorded on source documents like receipts and invoices.
Profit is the difference between the buying price and the selling price. If the buying price is 50 and selling price is 70, then the profit is 2070-50. Trade is the buying and selling of goods with the aim of making profit. The selling price is normally higher than the buying price.
Goods are physical items used to satisfy people, institutions, and business wants and needs. Examples are bread, meat, clothes, cars, machines, and others. In accounting, goods bought with the aim of reselling at a profit are referred to as stock.
Services are not physical items but benefits or activities done to satisfy people, institutions, and businesses. Examples are entertainment, education, medical care, banking services, tourism, legal advice, and others.
A proprietor is a person who invests their money in a business with the aim of making profit. They own the business, and if they are alone, they are a sole proprietor or sole trader. A business is always started with capital.
Capital is the money contributed by the owner to a business. It's used to buy, rent, or pay for the needs of a business like buildings, machinery, equipment, furniture and fittings, stock, employees, managers, and others. Capital comes from the owner's savings, or it may be borrowed from friends, relatives, a bank, etc.
A cash transaction is one where money is paid before the seller hands over goods to the buyer. Payment is made using cash, cheque, a debit or credit card. A credit transaction is where full payment is made after the buyer has received the goods or enjoyed the service.
There is either non or just part payment before the goods cross from the seller to the buyer. A credit transaction is only made if the seller is sure they will receive their payment. When a business engages in credit transactions, then it gets debtors and creditors. A seller on credit is a creditor, while a buyer on credit is a debtor.
Financial year is a 12-month period. For a new business, it stretches from the date of registration to the day just before the registration date in the following year. For example, if it was registered on the 8th of May 2008, its financial year ends on the 7th of May 2009. The following year starts on 8th of May 2009 and ends on 7th of May 2010. This trend continues until the owner gets permission from the Revenue Authority to change the dates, or when the business ceases to operate. The end, and thank you for your attention. We hope you enjoyed this chapter. Brought to you by the Association of Practical Accounts APA.